Righty-o, money. Nah, that's not that fucking good. Sorry, listeners. Righto, money miners.
Doesn't count unless I go deaf the first few minutes.
That's probably why my audio, I've got to sort my audio out because it's just this one peak at the start and everything else is...
So I turned the dial down for the first bit and then I adjusted it up so I can hear you normally afterwards.
Right. Maybe I'll cut them. Interesting. Is this the episode?
I think it is, mate. What are we talking about today?
We're fucking Liontown, Northern Star, Yancoal.
What a mix.
The table of contents.
Three big companies, three different commodities.
Quarterly season.
Yeah, mate.
We've got a ramp-up story. We've got a massively cash-generative story compared to a lot of the other companies we talk about. And then we've got
a growth story.
A growth story. Which one are we starting with?
Let's go Liontown. In respect of what got us started at Money of Mine, the lithium bull market.
Still that popular, I reckon.
Mate, there's yes. Are they paying a dividend soon? Best
I wouldn't hold
question
my
on
breath
the
on that
call.
one.
Oh, I loved it. He's like
Yeah.
my chairman. My chairman is
He's eager for a divvy.
always asking about it. Don't worry. Oh, loved it.
Might be
It.
waiting a
Right,
few more
take it
quarters.
away, JD. Bloody up. Oh, they were up 10%. They were up as high as 15%. I think they were finished about 12 or something.
Yeah, it was good. It was good
Right.
on the operations. We'll talk about, ramp up, obviously, cash generation, getting a bit of a better sense of what costs are going to look like. So I think that's the...
Maybe.
Yeah, maybe. I mean, better than what it was last quarter. We're getting an idea, but obviously it's that, transition from open pit to underground that we're going to see over the year. So it's hard to get a proper gauge. But let's talk about what we kind of do know. What we do know is that for the half year we're now in, that's the first half of this calendar year, they guided to Aussie 775 to 855 per tonne on a spod 6% basis, unit operating costs. So not all in sustaining cost. That metric came in at $1,000, but obviously that's for the quarter before. So it's put them in decent stead to kind of get there over the half year we're now in. On a production basis, just under 90,000 tonnes. That came in a lot stronger than a lot of people thought, and just maintaining that should hit the guidance numbers that I just presented, because they sort of said 170 to 185,000 tonnes. So looking at an all-in sustaining cost, getting a bit closer to what your real costs are actually like, we're talking US $763 a tonne, including freight, $790. Compare that with the sales price, which they spoke about, $806 US, and you can see it's kind of close. Bearing in mind that is provisional, so you have to look into the footnotes with a fair few of the things they talk about here. But what that really means is that 31,000 of the 80-odd thousand tonnes that they sold was provisionally marked as of December 31, hadn't actually been sold. So the actual price they receive could be a bit higher, given that spod prices have been trending higher. And there's a whole thing with how their contracts are set up, the prices they actually get, that we don't kind of need to get into. It's a bit detailed, but
So their realised price is 806 for SC6 equivalent, and they're selling at SC 5.2. Correct.
That's right.
Yep.
They produced a 5.2% product.
Which seems...
But those costs were on an SC6 basis as well.
Oh, okay, yeah. Gotcha,
Yeah.
brah.
Aussie dollar helpful there too as well, right? Like if you're reporting your all-in sustaining costs in the US. But
Exactly. Aussie dollar was a tailwind on a few fronts as well. They've obviously got a pile of cash at the moment and stuff. But yeah, on those ones, like with most commodities we talk about, helping them out for the time being.
Right. So they said they generated 17 mil of net cash from operations.
That's right.
Is that valid, Jonas Benedict?
Well, that is what they said, and it's by the accounting book, because they haven't yet said that they have reached commercial production. So they gave a fair bit of detail here. Credit to them for that. So you can chalk off $5 million of commissioning costs that were capitalised, they said. So they say sort of underneath it, 12 million is roughly the numbers. But then, as we're going to talk about, you get into a whole lot more detail, and it really comes to that open pit versus underground mining difference, what's being capitalised. A lot of that underground development has been capitalised, as you can see clearly in the waterfall chart here. somewhat to the
I
right.
think it's all been capitalised.
On the underground side,
Yeah.
that's right. Yeah. So expecting commercial production to be announced around mid this year. First stoping is starting in Q4 of this financial year, so next quarter from where we are today. And then open pit mining will cease in about a year's time.
Yeah.
So that really ties back to why I said we haven't got a firm understanding of what costs are going to look like, because there's going to be that transition period over the next year.
Yeah, and I think because everyone wants to, and a lot of the questions on the call were like trying to get a guide for the sustaining capital, because at the moment it's an open pit. They're developing an underground, so it appears that 28 million that they've said capital, underground development, and other sustaining. They've sort of bundled that together. I think other sustaining is referencing level development and ore drive development that will be sustaining in the future.
Yeah, work on the vents, these sort of things.
Operating development in the future, but because they're not producing from the underground yet, like they're using, they've got 30-odd thousand tonne of ore development. They're saying that is in that bundle.
Yeah.
Which looked a bit high. So I think in the future, it's like a good chunk of that 28 million that'll be the operating development will be I'm not sure how much of a chunk, but there will be a chunk of that will be flicked over to that payments for operating costs, and it'll be a underground environment, not an open pit mine.
And they spoke to this as well, right? We listened back to the question a couple of times. The indication they gave that sustaining total, 28 is a bit high. That should moderate a bit. Expect that to come down in future as a sort of standard sustaining capital number that needs to be spent every quarter.
But I think, that will come down. But I think that'll be
goes into the other pile.
It's the query is how much is the operating cost going to go up when a lot of that's going, because they're still going to they've got 2 jumbos operating.
Yeah,
they're always going to have a minimum of 2 jumbos, I would anticipate. They said they deferred the 3rd jumbo to, I think it was calendar year 26. So it's going to be a pretty, whether they're always going to be probably doing a bit of decline or it's going to cost a pretty similar amount each quarter for 2 jumbos to develop over 300 metres each. So that cost is not really going to change. It's always going to be there, and they're going to be trying to get that same amount of output out of them. So it's going to be a big. I know when the open pit finishes, you're going to replace the open pit equipment and the open pit mining with underground equipment. So there is a change out, but underground is. You would think it's more expensive than open pit. This is going to be a pretty bulk mining version of underground. So we won't really know until probably FY26 anyway.
Right. So the
quarter 1, quarter 2 till that's all.
The cash generation here is the open pit cost, but obviously the long term here is underground.
Yeah, exactly.
I think that's fair to say. And on the development, it was a decent quarter again, sort of edged out to be a record quarter by I think 30-odd metres. Like you said, a bit over 300 per jumbo per month, which is decent. And, good signs like ventilation, raise bores, paste reticulation and the paste plant, all these infrastructure type projects were ahead or on schedule, which is, positives.
And there will be a lot of, in that mine development and everything, there will be costs at the moment, like your early ventilation raises. Like even though there is a 3rd decline, to my knowledge, that is the ventilation drive, but they're setting up your first vent risers if there is any of the surface, like fresh air intakes, escapeways, but there's the pump stations, the substations and all that. So when they were talking about the early heavy capital that is going on, there will be some of it, but not as much now, not as much as there is now.
Over the quarter, they built up a handy amount of stockpiles as well, which would de-risk that period we're going to see over the next year if there is any sort of hiccups along the way. 1.3 million tonnes now in stockpiled, mostly built up from clean ore plus the ore sorting stockpile that they call it, which they've actually spoken about putting together through the plant altogether, as opposed to what the previous plan was, ore sorting it. That is product that sort of sits there, or that sits there with more dilution, more kind of deleterious elements, if you like. But they're trialling different things, and they said in January they're already trialling lumping that all together, and then just putting it through, seeing what the outcome is, seeing if they can still get the right recoveries and those sorts of things.
Yep.
So that sort of leads us to talk a bit about the recoveries of the whole operation.
Yeah, what are they up to? 59%.
59% for
recovery, targeting 70.
for December. That's right.
Yeah.
So as Tonio called it, this is the holy grail of lithium sort of production. Recoveries are super, super important. That'd be an area that I'm sure heaps of analysts scrolled to. They were keen to see. So talking about throughput, you had about 620,000 tonnes go through. That's, comes out at a bit over 2.4 million tonnes per annum.
Yeah, well, nearly 2.5.
Yep.
Yeah.
On a 2.8 nameplate. So they're getting there on that front. 70% by Q3 FY26 is what they said they want. So essentially 1 year to get themselves up from what they did in December, 59% to 70%. Beyond that, we don't actually get too much information. Like they previously put out what the week-to-week improvements were in the last quarter, but now we just get a kind of standard number for each month, and that went from 52 to 54 to 59 over the 3 months of the quarter. So
and that's pretty impressive that it's going up and they're lifting the throughput, because that, like, when you're lifting the throughput, you're going all in. Not like, I'm sure there's a lot of live changes and everything that goes on with how the plant works, but if it's heading in the direction and they're nearly at 2.8 million tonne, that's that's good. But like as we said, between and he talked to it as well, like the massive balancing act they got between the reagents, the de-sliming, and the grind size, like, so
can't have it too big, can't have it too small. It's a
a
balancing act.
And interesting to see what the underground feed, if that is going to, change the recipe for how the plant's going to work compared to the open pit.
100%. We'll keep our eyes peeled for that one. The feed grade did improve this quarter versus last, so 1.3 versus 1.2.
Yep.
Better grade, better recoveries. We all kind of have spoken about that quite a bit, but overall the trend was very positive, and I think it kind of exceeded expectations. To be honest, I think most expectations were just straight lining where we were to 70% in a year and a bit's time. And if you're calling it like that, it was an improvement. And yeah, they're on the right track there. But like I sort of said, there was about one page covered with a couple charts there. So we'll have to wait and see what the team can chalk up there.
I think they'll be going straight to the high grade, I would imagine, underground. Like,
I think that's a pretty good guess, mate.
That'd be the best place to go. So it'd be interesting to see, even though there was only 30,000 tonne of development ore, if they're going straight to the high grade, you might see a bit of a lift from the development ore component that is a bit of high grade going through the feed next quarter, to lift it all up with the pit. And then, so they might, as I said, it might cost more underground, but if they're targeting high grade straight up and getting, the 1.6% shit. No, the reserve grade was what, 1.4. So if they're getting well above that at the start, definitely help things along.
I think it will.
Go for the good stuff.
On that sort of theme, let's talk about the cash, because that's what really matters for this company in the sort of crunch point that we're in. Ended last quarter with 263 million. Ended this quarter with about 193 million. And the numbers are always going to be lumpy. Single asset company, non-precious. We're talking about 4 shipments that went out over the space of the quarter. But you had another 45 million. So of that 70 million sort of difference there, 45 was project CapEx. So 11 million more of that needs to go out over the next half year. And that's sort of done, which is good because that was an improvement on what was flagged just a quarter ago. But we're getting closer and closer to seeing what that could look like in due time. And with about 200-ish million in cash, you've got 700 odd million in debt. So that's roughly 410 coming from the notes with LG, and then about 330, including what's been capitalized with Forward. Both roughly sort of 5 years. The 5 years started mid last year for the LG component, and it's going to start mid this year for the Forward component. Right now, they're still capitalizing all the interest expenses, so they don't have to pay those ones. But by 6 months into this year, they're going to be paying interest on the Forward component. And by mid next year, they're going to be paying interest on the LG component. So that's more expenses. That's cash going to go out the door each quarter or each half year in the LG case that they need to pay. So I think a lot of eyes are on those too.
I think like the bullet payment in 2030, that's a bit similar to Regis. It'll just be there forever, and hopefully just knock her off 6 months early, and should be all good. Hopefully,
700 odd million is a fair bit of cash, but I've no doubt that the lithium environment will go through a few sort of ups and downs between now and then. And maybe if there's a really rich spell and things are going well, you can refinance things and capitalize on a better environment. It's a long way away. Thankfully for the company, it's not something right up in their face.
Yeah, I think once production starts, and as we said, they'll be targeting the high grade underground. They'll be hopefully probably Q1 FY26 will be the sugar hit period, because they should technically be free bogging a shitload of high grade dirt underground. They won't have to be paste filling, like they'll open up a few stopes at once, and they'll just start ripping out the good stuff, and that'll be going straight to the plant. Because until those initial stopes are empty, they don't have to be paste filling, they don't have to be spending money on cement and everything. That's when they're really got to make the most of that underground to try and get a bit of cash in the door. They'll
be crossing their fingers and toes that coincides with a period of good pricing, right? And on that sort of note, we heard them reference, and it was in the news over the weekend, that Albemarle sold a lot. I mean, it was a kind of one paragraph article, so there was not too much that came out about it, but the price they quoted, and I'm not sure when it was actually changing hands, was US $921 for SE6. So regardless, that's better than where we were half a year ago. And, if that sort of trend continues, along with the improvements in operations and everything, then it could, inch their way towards a bit of a better place.
Yeah, yeah. They could just mine all high grade and not fill them like Nifty did.
Let's hope it doesn't come to that. That dramatically chalk off the life of the operation. But I mean, taking a step back, the quarter operationally was a lot of positives in there. It doesn't really speak to the valuation of the business or anything like that. Like we said, dividend might be a while away still, but there was a lot of positives to kind of take, and it's kind of understandable why the share price ticked up 10% today.
Yeah, I want to go back to the cement. Sorry to keep harping on about paste fill. I just want to know, I don't know who's supplying that cement up there, because that's going to be the most critical thing for that operation, is that paste fill consistency and everything in the future, because there's the paste backfill production balance. I'll just recommend, once they do figure out who is supplying the cement, get them to call Derek Hurd from the Sandvik Ground Support division and get some tips on how to consistently supply a product to a mining operation forever. Because don't you think the Sandvik Ground Support division are the best in the game for delivering shit every day forever?
It's not just bolts, it's everything you need, right?
Yeah, cement is exactly the same as ground support. You're going to be using it every day. Call Derek, get some tips from the best. Maybe if they should start Sandvik Cement.
Maybe they should.
That actually sounds good too.
Logical next step.
Sandvik Cement.
What do you think of mines that don't have DSI ground?
Shit.
Just shit. Uninvestable.
Pretty much, yeah. The CapEx number's huge. The operating cost is huge. The waterfall chart just ends up going backwards. So, yes. Give yourself a good waterfall chart and call Derek Hurd.
Go DSI.
Oh, buddy.
All right, Matty, let's talk about...
say DSI?
Sandvik DSI.
It's still in my heart.
All right, let's talk about Northern Star.
Oh, God. Bloody... Northern Star, can you just go back to having Paulson's? It was so much simpler. So much going on here. And I don't think I've provided anything. But
big company.
Anyway, it's pretty flat.
Pretty flat.
Seems to be tracking the gold price today. So what? 410,000 ounces sold, all in sustaining cost 21.28. So they've said underlying free cash flow of 72 million, and that does include 60 million of equipment finances and leases. This for an $18 billion company, by the way. Pretty bloody big. So ounces and cost second half weighted. So because they've sold 804,000 ounces so far, and so they need to sell another 921,000 ounces to hit the midpoint of their guidance, 1.725 million ounces. So now the big, sounds like it was a bit of a pivotal quarter, you'd say, something they said they're working 4 years towards, is at KCGM, the east wall remediation is done.
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 Wow, that's awesome.
Yeah, so they're actually now going to access the Golden Pike North ounces in the pit floor. So they're talking about like grades of, 2 grams a tonne in those pit floor benches. So that's going to be the kicker because you could see how much for KCGM for the open pit, how much lower the open pit tonnes were. So just a bit over 1 million tonne compared to like 3.5 million tonne for the quarter 1 year ago. So it sounds like that is really going to ramp up for the second half, and that's where a lot of the ounce uplift is going to come from to meet the guidance. What did he say? I think Simon was the COO was saying it's like something like 50,000 ounces in a bench or something like those 2 gram benches. So there's a lot of good dirt down there. So I would anticipate that that open pit grade and the tons are really going to lift in the KCGM pit. So, mate, 2 grand open pit. She's bloody deep down there, but
It's deep, yeah.
fucking hell, it's like driving up from an underground. But yeah, anyway, sure, they've been doing it for a while. They're going to keep doing it. So, and they're frigging humming at bloody KCGM underground. 7.2 kilometres of development for the quarter. So 2,400 a month. So I don't know, they've probably got bloody 8 jumbos there or something, and 7.4 kilometres of development at Jundee. So nearly 2,500 a month there. So still bloody flying. Delivered 120,000 ounces of the 400 odd into hedges. So that's why their averaged realised sale price is 3,700 an ounce. So interestingly, did not add any further hedging commitments. Consider out of the 3 out of the last 4 quarters, they've always added hedges. They added a big chunk, bloody 285,000 ounces or something 12 months ago. So, yeah, you'd think at this really high gold price, it's like they probably would have got a good price for adding some hedges, but they haven't. So it'd be interesting to see if their hedging policy will change. Still 1.7 million ounces hedged at 32.42, delivered up until the June half 28.
Gotcha.
So, yeah.
It feels like, one of those, without context, there's a lot of ounces hedged there, obviously, but they produce a lot of gold. But maybe they're copping some flack on some of the hedge book, or maybe the typical thing that happens with capital allocators in the mining industry is they go pro-cyclical and they're like, oh, damn it. This isn't working. I'll stop it.
And they as they said, I think it was the last quarterly conference call. They're like, look, hedging never works in a rising gold price environment.
Gold price has been rising for decades now, but I mean, it looks like the classic 1/3 for the next 3 years.
Yeah.
So 600 odd thousand. They're doing 1.7, 1/3. Yeah. And it just looks like you said there, the June half in 28, they haven't upped it. Classically they would have added another 300 odd thousand for that half year period, and they've sort of held the trigger on that one. So we'll see.
So see what they do next month. So they also received about $206 from Goldfields after they converted the con note they had with a Cisco.
Someone told me about this. They put it on my radar. Yeah.
So it was it was just in October. So obviously they converted the con note into Cisco shares. Then obviously Goldfields took out a Cisco mining. So it looks like they profited, I think it's 37 million, something from that. But it's funny on the debt front, because their debt is a US $600 million bond. So the actual Australian dollar value of that debt since the last quarter has gone up $100 million, because it was at 69 cents last quarter. Now the Aussie dollar is at it was marked at 62 cents.
You know who else has a lot of US denominated debt?
Good friends of the show.
So for that 772 million underlying free cash flow, they spent another 79 million on the share buyback. So it looks like about 50 million to go on that $300 million planned buyback. I think that added up to 250 million total spent so far. So,
what about the capex, mate?
$800. $800 spent for the first half so far. Yep. So 1.5 billion is scheduled. So sounds like that east wall remediation was, a good added to why it was a bit more first half weighted. So as we repeat, going through high capex period with the KCGM expansion, so a bit below 400 mil a quarter total. That's so I guess the capex outside the KCGM expansion is still 250 mil a quarter plus another 125 mil a quarter for the KCGM side. So you think of Evolution's capex, they're about 185 to 187 in the last 2 quarters each quarter. Granted, bloody Northern Star's market cap's 18 bill, Evolution's 11. So, but it probably does show a bit that Evos are probably a bit more in cash harvest mode in a way.
Except for Mungari, that's the only exception though. That's where the money's going.
Yeah. And even that's getting to the sort of the more than halfway through that spend period there as well. But it strikes you when you hear the free cash flow number that you said at the beginning, 70 million for a $18 billion company.
Yeah.
And you look, a lot of capex being spent around the grounds.
And because you could say they're in growth mode until FY27 when the KCGM expansion is complete.
And De Grey.
But then Hemi, if that goes through, they didn't bite on comments regarding Hemi. Just said won't really give much until the transaction goes through, which is scheduled for May. But if you think that KCGM expansion's going to finish, then bring on another potentially $2 billion at least capex to build Hemi. Going to be in another section of it's equivalent to the KCGM mill expansion plus probably way more capex to build that. So it's sort of
they put out their quarterly today too, and there was one bullet around
approvals
and a deferment of a I think it was a federal approval by 6 months. I mean, everyone was expecting something along those lines anyway. I think once that De Grey transaction hopefully goes through, or maybe before, who knows? It'd be interesting to see if they're going to be divesting some assets or not. Like Karasu Dam possibly at the top of the list, hearing that mine life extensions there would need a bit more proving up to extend it. Like look at Thunderbox and Bronze Wing, like that's their highest cost sort of operations. Definitely probably keep Jundee and Pogo, keep all the Kalgoorlie stuff to feed the shit out of the mill there. Now that Hemi's possibly coming into the portfolio, bit of cash in the door that should be heading straight to Paul Natoli's pocket for the Hemi camp for grounded.
Definitely.
That's like make that easy for Paul, but easy for Northern Star as well.
It's hot out in the Pilbara, mate. But you know what makes working in hot weather better?
Paul Natoli.
100%.
and grounded. Here, we'll have it. It's funny you mentioned where it's located, Trav. Have a look at where it is. Right up in the bloody. It's the shoulder of Australia.
Mate, there is no exception. Tony O said it'd been 40 degrees every day out at Kathleen Valley. There's nowhere in WA where you don't need a grounded camp.
Oh, mate, well, and especially in this one, because have a look at what it coincides with. Region D, severe tropical cyclones. That is like Hemi is there. And also in that frickin' purple patch, which means the hottest band in Australia. So I'll tell you what, if I'm going up there, I will want that bloody Hemi camp to be frickin' cyclone proof and supercharged aircon. And mate, grounded have they have those camps ready to go.
They're the people for you.
Camp's the wrong word. I think we've got to call them resorts.
Yeah, resort.
Village feels like a retirement thing, but they're better than that.
Yeah.
You know who else calls them a resort, Trav?
the same company that has a lot of US denominated debt.
Oh, mate, I'll tell you what, if I'm going up to friggin' south of Port Hedland, just make a good recruitment decision and put another G spot on the WA map.
Go grounded.
Go grounded.
Let's talk about Yancoal.
Yancoal.
Trav, you tuned into this one.
Ding, ding, ding.
Yes, for all the filthy coal stock lovers out there, which I am one of. Ding, ding, ding. You're right, Matty. I own Yo. There's a few things happening with Yancoal at the moment, which kind of puts them in the spotlight, makes them kind of interesting. You can come up with your thesis for why the stock price might move either way based on where they're at and what their capital allocation is. And the quarterly results that they dropped late yesterday, they always drop them after market, were pretty strong. Cash up $480 million in the quarter, so the stock price shot up 6%, which which is pretty hefty move for an $8.4 billion market cap company. Notably, that their cash balance is 30% of that market cap, standing at 2.5 billion Aussie dollars as at the 31st of December. The cash balance is key focus for shareholders who are trying to read into like every word as if it's like the Fed Reserve minutes to figure out if they're going to get a juicy dividend in 3 months' time or not, because
The dot plot.
yeah, it's like, what are we going to get? And like we kind of talked about a fair bit last year when Yancoal determined to pay no interim dividend, I think it was like 3-ish months ago, it caused kind of a bit of mayhem. The share price, just fell off pretty dramatically, as a lot of the yield hungry shareholders, they had their base case squashed. They were hoping for a payout back then, but of course the Yancoal's rationale at the time was because they were in the bidding process for Anglo American's portfolio. They were retaining cash to put in a competitive offer, but in the end, Peabody got the chocolates with the bulk of that portfolio, and Yancoal stayed on the sidelines now. But they're now rumored to be pretty interested in buying Kestrel instead, which is undergoing its own sale process. All of that to say, most of Yancoal's shareholders would be absolutely thrilled to see the company sideline its M&A agenda and focus on divvies instead. But the trouble is, most of the shareholders account for very little of the actual shareholding, because it's top two Chinese shareholders own 70% of the shares in the company, and the rest of us are frankly passengers to their agenda, I think.
So what's your view? Dividend or not?
That's the question on everyone's mind when divvy. And they were taking webcast questions on the call. You can kind of tell they were getting peppered with divvy questions. I'll play a few snips for you guys.
There are several questions coming through on the topic of dividend outlook, dividend policy, capacity for dividends into the future periods. Kevin, during the scripted comments, we had an introduction saying that we have some capacity for dividends. Are you able to expand on the company's policy and what we can say at this time ahead of the board meeting?
Sure. Thanks, Brendan. Same as what Brendan just mentioned about the company strategy, doesn't change. Same thing for dividend policy. It doesn't change. I can reiterate the policy again. We have this 50% NPAT or 50% free cash flow, whichever is higher. This is the guideline for the management to plan our dividend distribution. At the end of the day, dividend is the board decision. So board will meet in February to decide, in this case, in 2024, a full year dividend. Also on dividends, this is something way just back to what Brendan just mentioned about the corporate strategy, is a part of our capital management philosophy, basically balancing a growth story with a good return to our shareholders. As Yancoal doesn't have any debt, so we don't really need to worry about the cash outflow to manage our facilities. As a result, it's very much to see how this sufficient cash flow to manage both the growth opportunities and also our return to our shareholders, which with this $2.5 billion cash in the bank, we definitely are able to manage. Thank you.
That's a fucking sick bloody video thing.
I've seconded it up for you, yeah.
That's not how it was released.
Nah. It was actually really bad audio quality, but I've improved the audio quality and added some pictures for you too, mate.
Oh, how good's that?
I thought Yancoal had done that.
No.
I'm going to do that for the Bella Vista quarterly.
10 minutes later in the call, we got this as well.
We've got a few follow-up questions on that topic of dividend. Kevin, do we have an expectation for distributions in terms of finals and interim dividend over the coming year, given that you've already touched on it's very much at the board's discretion?
Thanks, Brandon. I noticed some comments on the web link. I can see question relates to the company skip 2024 interim dividends, and which is actually the good example for us to say we've been balancing and managing the dividend on a year basis, and then subject to the corporate initiatives and the strategic priorities. So we still stick on to the existing corporate dividend policy, and we will assess the dividend return to our shareholders, basically assessing the full year performance.
So you can see a lot of dividend questions are really just coming through on that webcast.
The
Another
topic
one?
of the dividend is coming up again, Kevin.
You get the picture. Eh?
Oh, is there like so here's a question from a member of the Steve Ray Fund.
Yeah.
After what happened when they announced they weren't doing a dividend and the share price going from mid sevens down to below 6 and everything, like, and as I asked you before, like if they did release a dividend, normally stocks go ex-dividend and go down the same proportion. But if they did release a dividend, which would indicate they're not pursuing M&A, would it, like, the stock re-rate back up to where it possibly was?
Yeah.
What's the thoughts? What's the public thoughts there?
You're all trying to figure out what's priced in, and are you going to get a better outcome than what the stock price is currently pricing in? My thinking on this has changed a little bit, but I actually think the stock is pricing in just a relatively normal kind of dividend to be based on the dividend policy.
Not a super dividend.
Yeah. Now, if the announcement of that dividend is above expectations, I'd expect the share price to shoot up, and then ex-div it'll fall off. But it's all about when that dividend, the quantum of it is announced. Is it above or below expectations? Shareholders, I mean, you can tell by how frequently people ask about dividends. Shareholders care way more about dividends than they care about M&A. But like I said, us small 30% of the shareholders don't really have too much of a say when you've got the other 70% would have the biggest say in this vehicle. But that's what you get with Yancoal. It's cheap for a reason, of course.
To add to that, Maddie, to your question specifically, I think if they were to accommodate that with wording saying, hey, we're now on a strict dividend policy, we are no longer looking at M&A, those sorts of words and stuff might encourage shareholders and might be a bit more of a catalyst in conjunction with
I brought up the dividend policy in the Constitution, and the way I read it, because I was just trying to figure out everything. The way I read it is like they are committed to paying 50% of free cash flow or NPAT, whichever is higher, in each financial year. So the fact they didn't pay the interim one just means that it's going to be a higher one in the end of financial year. However, there are provisions in this dividend policy to pay a lower one if prudent, and there's also provision to pay no one if it's particularly financially prudent to do so. I don't know if, like, my base case isn't that they're going to. I just think they'll pay 50%. That's my base case, and we've got first half earnings already, and Yancoal, they actually report their financial year in a calendar year basis. So we've got the 2 quarterlies already for the second half of that financial year. You can estimate NPAT, you get pretty close to 1.5 billion for that full financial calendar year, which kind of gets you close. If you take 50% of that, you kind of get about 57 cents per share as a base case dividend is how I think about it. And that would still leave Yancoal, if they paid out 50 cents, it's a 50-cent divvy on a $6.32 stock today. It's only like a 9% divvy yield. That would still leave Yancoal with a shitload of cash on balance sheet too. Like, they'd have over $1.5 billion of cash left on their balance sheet, which in an ideal world, they would mostly distribute to shareholders as well. That'd be great, but much more likely they're just going to hoard it for M&A optionality. Going to have to wait until February for that though.
Is there a chance that the ex-divvy date will be later than... Because I'd like to see you get your dividend so you could spend it in Indaba when you're over there.
Also in February. Next week.
So, it'd be too late, wouldn't it?
Yeah, I can't remember
Early
which
Feb.
day exactly. Early Feb. We might still be in Africa.
Yeah. Just, Yancoal, can you please take the boys' Trav's travel into account? Travel.
Yeah.
Divvy would go a long way in the DRC as well.
Yes. Right. What are you going to get up to? Mate, you might end up with a mining asset or something, JD. Bit of a little backhander deal.
Come back with a copper mine.
Yeah, maybe you can I had to pay like a few $100 for some immunisations just to go to the DR centre. So maybe the divvy can help subsidise my medical costs.
I can't wait till you come back from Indaba and say, look, we own
Picked up a couple
we
tenements.
just picked up a couple of million ounces while we're over there.
If you're going to Indaba, hit us up. Yeah, it'd be good to catch up with you while you're over there, money miners.
We are pumped.
I'll start finding a shell.
Alrighty, let's talk a bit about the state of coal markets, specifically thermal coal in this case, that is Yancoal's base product.
Yeah, elevated coal markets 2022, they've rolled off, and you can see both thermal and met seaborne indices constantly. They're just like grinding lower and lower for the last 2 years. But even as prices have moderated, Yancoal still captures a really healthy cash margin because its mines are generally very low cost.
With a lot of costs as well, inching higher and higher.
Yep.
So it's impressive to still make a decent chunk of money.
Totally. I mean, they bought these mines off like the likes of Rio Tinto, so it's no surprise that like they are really low cost mines.
A lot of my mates I went to uni with did like vac work at Mount Thorley back in the day, which was one of their ones.
Yep.
There you go.
It was the Rio days.
Yeah, I could actually find a cost curve of seaborne thermal coal, the cost curve. But here's the two components of that chart anyway: total cash costs and production. You can see the three mines of Yancoal that account for the vast majority of their production are all relatively low cost and large scale.
They're big operations.
Yep.
Seriously big operations.
Yep.
So what about the bear case for the company? What are you kind of thinking there as a shareholder?
I think there are a few things. As usual, bear case involves less than optimal capital allocation. The nearest risk being overpaying for Kestrel. But honestly, like buying anything is possible for this company. Like they always talk about, they buy base metals, they buy things in other countries and all that sort of stuff. And to date, like we haven't seen anything silly on that front. But it doesn't mean you rule it out, especially when a lot of their talk is about being acquisitive for a growth story. But I think it's worth drawing the money miners' attention to a somewhat ominous resignation of the CEO, David Moult, announced a week ago. He was CEO for 5 years, and when this was announced, I think it was announced after market. It said his active duties ceased from today, which meant that Mr. Ning Yu was stepping in as acting CEO, and then in less than a month before David Moult resigned, another independent non-exec director, Jeffrey Raby, stood down from the board too. Now, when asked on the call today, the responses were basically insisting that there's no change to the strategy from the company with the CEO transition, et cetera, et cetera. But my mind begs the question. I think a cynic could look at those resignations and come up with a reasonable hypothesis that there was some wrestle over strategy. Like that's a reasonable possibility here. Could Yancoal, for example, be like red hot on Kestrel despite it being an average asset? That's like a plausible thing in my mind, or it could be litany of other things. But I don't just assume that there's no strategy differences when you see kind of an effective immediately sort of resignation.
A CEO doesn't leave effective immediate if all things are just tickety-boo.
It's technically employment continued. That might have just been a provision of a contract or payments or something. But his active duties.
We pay out the next 3 months or 6 months or whatever, but we don't want you here tomorrow. Like that's not a great sign.
The announcement also said I was basically saying we agree there was basically no disagreements between the board and the CEO. I don't always believe that, but anyway.
Who else is in the hunt for Kestrel?
There'd be the usual suspects. M Resources would be right up there in some, they might be looking at a consortium again with like Stanmore and the Wijaya family, as we've seen them pop up in the past. But there could be, who knows, Matty? Like I think the takeaway. Have you seen what's happened to Peabody stock share price since they bought the Anglo portfolio? It's halved.
Oh wow!
It's been hammered. So the markets, their balance sheet is really stretched. Met coal is under a fair bit of pressure. It's like, when's the last time a stock's been punished for overpaying for a coal portfolio? It's really interesting to watch. So
a bit of shareholder alienation as well.
Yeah.
A portion of the base at least, kind of like the decision with Yancoal 3 months ago.
Yeah. And the met market has a few other pressures, on it that thermal hasn't quite had yet. Notably, I think there was some agreement recently for Chinese export or import capacity from Mongolia to lift from 80 to 120 million tonnes per annum, and that obviously just displaces more seaborne met coal from the market as well. So it's more complicated, yada yada. But yeah, let's see what happens there. And I think that's like the last thing to point out is that some analysts are also bearish thermal coal too. I read a note yesterday that China's reaching peak thermal, or trying to reach peak thermal in 2024. There was this like $25 to $30 per tonne premium in Newcastle over onshore China volumes, which persisted for most of 2024, which has sort of been eroded over the last year. Indonesian suppliers humming, and India's increased domestic production, and India's increased their own domestic production. They've got like this increased agenda of self-sufficiency. So those are that's the bear case for thermal coal as well. I think I'm obviously taking the other side of that trade, but that doesn't mean I'm right. Like I could very well be wrong.
Yeah, but mate, if you're still producing it, it's not going anywhere anytime soon.
Yeah, it's an interesting market, and people are a bit bearish China generally, as well as that sort of peak energy importing kind of narrative and all these sorts of things. It's an interesting little point we're in.
It's not going anywhere in Australia anytime soon, that's for sure.
Mm.
So,
and a lot of companies impacted by what you just said as well. Glencore being a big one too.
Totally. Yeah.
So Glencore at the moment, they're majority thermal.
Yeah, after buying Elk Valley, like that's just.
But before Elk Valley, they were majority thermal.
Yes. Yeah.
But now they're majority met.
Yeah. Their Aussie coal assets are majority thermal.
Yeah.
Still, but good assets up in Canada now that are met coal.
Yeah. Gotcha.
Righty, couple partners to thank.
Mineral Mining Services are not majority open pit. They are open pit bloody mining contractors. Don't go underground too hard. Fuck that. Mate, grounded. Chuck a G-spot up at Hemi. Can't wait. Sandvik Ground Support Division. CRE Insurance. K-Drill. Dash Sat. And
Saltbush
Contracting. And Get Wet Solutions. Oh, Nathan Dash. Congratulations on becoming a father.
Well done.
Well done, Dashi.
Hooroo,
Money Miners.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.